welcome back. Glen Thiessen is back with us, and certainly, I mean, there's risk out there. I don't know, $2 billion for a baseball team seems risky to me. Glen, well, first, welcome back. How are you?
Thank you. I'm doing great. Thanks.
Yeah, good. I'm happy to have you back. I'm glad you're here. Are you a baseball fan, Glen?
I am.
Yeah? Were you up till 3 o'clock in the morning watching the Mariners?
No.
Or I guess it started at 3 o'clock?
No, I'm not that much of a fan.
No, I'm not either.
No. Unfortunately, I'm more of a fair weather fan.
Yeah, so you like the Mariners like maybe, beginning of April?
Yeah, pretty much. and then fading out by June.
And we get excited for the Seahawks. Okay, Glen, risk is certainly something that you guys deal with every day at transition planning. I mean, you help clients really navigate major changes in life from the financial side. What are some of those big kinds of risk that people don't really think about very often?
Well, I think when we say the word risk, the first word that comes to most people's mind is loss, right? I might lose something. Well, that's true. There's an emotional aspect to loss and risk. So one of the first things that people think about when we're talking about investments is how far can I go? How much can I lose before just not being able to tolerate it anymore and just bail out? That's called risk tolerance. That's only one aspect of risk, but that's really the most powerful because it's what causes people to maybe bail out at the wrong time.
I mean, that's kind of the going the wrong way, right? That's buy high, sell low.
Yeah, and that's a very bad strategy, by the way. So rather than just focusing on the emotional aspects, what you want to do is also think about what are your goals and what kind of risk should you be taking? What is your required risk in order to accomplish your goal? If you're not taking enough risk, like, for example, if you have everything in a savings account and you want to retire in, 10 years or whatever, and you need $1 million, you only have $500,000 in the bank, you're not going to make it, right? So you're too conservative. So you're not going to, what is the required risk? So that is important along with the emotional aspect of what is your risk tolerance.
Because you start kind of looking at, from risk equaling bad, there's the opposite side where risk can actually equal good.
Exactly. Right. So obviously every investment has its own unique set of risks and benefits. And so along with higher return comes a little bit higher risk. Lower return, lower risk. But you've also...
like Mega Millions. Sorry, I don't mean to interrupt.
Oh, well.
Very, very low chance of winning.
Right.
Huge upside, though.
Yeah, huge upside. Yeah, it's a bit out of the ballpark, you might say. So, okay, let's talk about risk capacity. How much risk could your portfolio stand to lose before you are past the point of recovery where you're not going to make it, right, after that? So there's the risk capacity aspect of your portfolio. That's important to take into consideration as well. So if investments start to fall, one of the temptations is to bail out. Well, what about liquidity? Perhaps your investment is tied up and you cannot get out. See, that's called liquidity risk.
So, yeah, I mean, you could think of that as almost like real estate or something along those lines where people have all their money tied up in real estate.
Right.
They can't get it out.
Yeah. There's a couple different ways, but it takes time, takes effort. The market might not be right. Other types of products like annuities might have a surrender charge. Penalties for getting out. CDs. People are afraid of getting out of the CD because they're going to lose 3 months of interest. Wow. It's not a huge, but it's enough of a deterrent.
On their 1.5% CD.
Exactly. Which also brings me right into the next type of risk, interest rate risk. Now, you are dealing with mortgage loans all the time. Tell me, are the mortgage loan rates generally higher than the savings account rates?
They are generally much higher.
Right. So what's unfortunate is that people often don't think about the fact that they're paying a higher interest rate when they owe something, whether it's a credit card, car loan, mortgage, whatever, than what they're earning. So if you're not earning a high enough interest to overcome or offset the interest that you're paying, you're going backwards pretty fast. Now, there's the whole argument, well, I need a mortgage because I have to have a write-off, right? A lot of people think that's important.
Well, you do have to consider if a mortgage is at 4%.
Yeah.
And and you do write that off, you're basically at 3%.
Right.
And there are places you can invest pretty safely for more than 3%.
True. But remember that when you write that off, that interest rate, for every dollar of interest that you pay, you're only getting back about 25 to 30 cents at the most in tax savings, correct? Because of the tax bracket you might be in.
Sure.
So it actually costed you 75 cents, let's say, to save $1, right? I mean, you spent $1, you only get 75 cents, back, or actually the bank kept 75 cents. You only got 25 cents of that dollar back in tax savings. So it's really not the very best thing for getting a mortgage for a write-off purpose. Right?
No, I would agree, not just for the write-off, but there is an opportunity cost of having, say, $1 million at 3%.
True.
Versus $1 million sitting in, or no $1 million at all.
Right. And, typically you got to remember that the cost on the mortgage is a guaranteed cost, where the return on an investment, unless it's a guaranteed fixed rate, is a chance. You may make it, you may lose it.
So
right?
what's the risk worth to you, right? I guess that's where we're going.
It's the offsetting factors. You got to look at the whole picture is what I'm saying. So in addition to paying a higher interest rate than you're earning, interest rates movement, the movement in interest rates will affect your portfolio. For example, if you have bonds in your portfolio and interest rates move up, which is typically what, where low interest rate, historically low interest rates, generally the next move is most likely going to be in the upward direction, wouldn't you say? I don't see them dropping. I don't see them
going down
further.
to 2.
Right. So as interest rates go up, that forces bond values down. So if you have a bunch of bonds in your portfolio, you're going to see the value of your portfolio fall, right? Because the bonds are going down in value as interest rates are going up. Now, it's good that interest rates are going up because people, in the savings accounts want to earn higher interest rate. But it's bad for bondholders, right? Because you're going to get that same interest rate on the bond, but the value of the bond itself is going to fall as interest rates rise. The opposite, if interest rates fall, which they have trended downward over the last few years, that increases bond prices. So people who have maybe higher bond prices than what they paid for originally may want to take a little bit of a capital gain on that, sell those bonds, right? But then do you
think it's hard? I mean, we talk about, we're here at the Glen Thiessen, we're getting into a lot of terms. Do you think it's hard for people to get, with your own money, It is almost impossible to wrap your head around all these different things that go into it.
It is.
I can't do my own mortgage. I have to have somebody else do it because literally I can't figure out how to work the application. Right. The same application, the same paperwork I've done 1,000 times.
Yeah.
But for myself, it's so hard to wrap your head around.
Right. Well, the main thing is to think about these things and how it might impact you. First, you got to figure out where you're at in life. What's the current snapshot picture of assets, liabilities, income, and expenses? Where do you want to go? What's it going to take to get there? What's standing in your way? Are you buried in debt? Can you rearrange assets and liabilities to free up cash flow? How can you improve your plight going forward by improving returns on what you have, reducing risk perhaps, and like I say, rearranging assets and liabilities? So start with a snapshot of where you're at today. Know where you want to go. What are your goals? What are your planned major expenses, and where do you want to be down the road, and what's it going to take to get there?
What are some of those things? Okay, let's talk about inflation. I mean, there's a risk there.
Mm-hmm.
Inflation is definitely a buzzword, right? You can hear Donald Trump talk about it about just every day.
Yeah.
You can hear different thoughts. You can hear the Fed talk about it. You can hear inflation is everywhere. I think to the average person, prices are going up. I paid $3.05 for chapstick yesterday.
Yeah.
Chapstick.
Yeah. Well, that's an oil product.
But it's like, I mean, I was blown away. I said to the guy at the gas station,
yeah.
I walk in, I had to fill my car. I was running late. I put some gas in. I go into the shell and I said, yeah, just chapstick. Where is it? Walk around, grab it.
$3.
Throw it on the counter. $3.05.
You got to go to Costco and buy a pack.
I said, it's chapstick. Like, it should be 50 cents. Anyways.
I know. I understand.
But everything is going up in price.
Yeah. Remember last time I was here, I told you I made a copy of the gas receipts from 2009, 10, 11. And this year went up 36% between 2009 to 2010, another 28% between 2010 and 11, and another 11% between last year and this year. And it's unfortunate that they don't include that in the inflation calculation. So let's just say, for example, if inflation was 1%, and let's say that you're going to be around 25 years, if you had a $1,000, all right, in your account, 25 years from now, that $1,000 is worth $778 in terms of purchasing power. At 1% interest, or inflation. At 2% inflation, that's only worth $603. And at 3%, which is what they say inflation is averaging, that $1,000 is only worth $467 in terms of purchasing power.
Less than half. And,
yeah.
and they do, I think the Fed says that they try to keep it between 2 and 3. I mean, that's healthy.
See, and that's the thing. Think about a person who is retired. They're on a fixed pension. If you're lucky enough to have a pension, that pension does not go up. Now, Social Security goes up a little bit, but really does it keep up with the kinds of inflation that we just talked about? No. So if your investments are not, if they're too conservative, if they're not earning enough above the inflation rate to give you what's called the real return above inflation, you're going to go broke. And if you're going to be living for another 25 years, you need to consider what your purchasing power is. So there's two things to think about. Are you more concerned with the loss of your money or the declination in the value of your money? Or is it more important for you that your money retains its purchasing power?
So it seems that when somebody talks to you about a plan, one of the biggest risks is really not having enough down the road. I mean, it's easy to worry about losing money on a daily basis. I don't know, the market's down today 100 and some odd points. It's easy to think and worry about, the risk every day, watching this up and down. But there's a kind of a bigger end game risk at the end of this, which is, what if you don't have enough?
Right. What if you outlive your money? That's a scary proposition. Because how do you recover from that? You don't. You go on welfare. Basically, society steps in and takes care of you. But is that really what you want?
No, I want my kid to be rich.
There you go.
That's what I want, Glenn.
That's fortunate.
Glenn, we have to go to break. Again, that's Glen Thiessen, Wealth Advisor with Transition Planning. When we come back, a lot of people have thought of the real estate market as a risk. But one way to maybe, lower the bad side of that risk is actually new construction. Sherry Putsky's going to join us and talk about the new construction market that's out there and why it might be a good idea. My name is Ben Brash, and that was Glen Thiessen. You're listening to Brashenomics.